The force will be with Disney this year. Morgan Stanley predicting that the newest Star Wars film will be the third highest grossing movie of all time and generate $1 billion for Disney's bottom line. Ben Swinburne wrote the report. He's a managing director at Morgan Stanley, and he joins us now from their offices in New York. So, Ben, this Star Wars movie, as you said, would be the third highest grossing movie of all time, but not enough to topple James Cameron as self-declared king of the world?
Yeah, I think our report really makes three main points. The first is we are quite bullish on Star Wars, and why wouldn't you be? There's incredible anticipation for the film, and you have Disney's global merchandise and marketing power behind it. The second is putting the movie in context. As big as that is, $1 billion over the 10-year ultimate of the film, we're still talking about only a 6% contribution to their net income and earnings per share for fiscal 16. And to remind people that over half of Disney's earnings come from their media networks, mainly ESPN and ABC, where we're much more cautious from a sector perspective. We have a cautious view on the media industry. So you're buying Disney stock at a 25% premium to the peer group. And as bullish as we are about Star Wars, we think that's relatively priced into expectations.
It's priced into expectations. So given all of that, what's the biggest risk to Star Wars not performing up to expectations and disappointing investors?
Yeah, if you look at the breakdown of the movie profitability, domestically, we think it'll actually be the second highest grossing, or tied for the second highest grossing domestic box office film. You've got Titanic and Avatar as 1 and 2. And then really international is kind of the interesting question. How well will Star Wars do internationally? We've seen a major increase in international box office results for big tentpole films over the last few years. And we raised our expectations for the international growth in this note. And the last piece is merchandise. We think the film will lift Disney's global merchandise retail sales to about $5 billion for Lucasfilm properties, which obviously generates a nice licensing revenue stream for Disney. But again, all that looks pretty well priced into the multiple and expectations for the stock.
Right. Certainly people can see out to what that will bring. When you talk about the merchandising revenue from Star Wars, certainly it'll be big internationally especially. How does that compare to, say, Frozen, which Disney has built into a nice franchise on its own without having to pay any kind of licensing?
Yeah, we think Star Wars is bigger. Star Wars could be one of the top, if not #1, global merchandise brands, certainly in the year after the film. We think currently, with no movie out in the market, it's doing about $3 billion somewhere between $2.5 and $3 billion of gross global retail sales already for the Star Wars properties. So it's already a powerhouse. So we think the movie obviously will drive incremental revenue once the movie comes out later this year in December.
Just to put this all into perspective here, Ben, Disney bought Lucasfilm in 2012 for just over $4 billion. What's the math on how much this film will cost to produce and then to also market, and at what point does the purchase really pay for itself?
Yeah, it's a good question. You could also throw Marvel in the mix there, which they also paid about $4 billion, and even going back to Pixar, between $6 and $7 billion. These films on their own generate reasonable returns, but it's hard to analyze the returns on these investments without thinking about all the derivative income they're generating at the theme parks and other parts of their properties. To answer your question specifically, we think Star Wars to make and market is somewhere between $400 and $500 million.
$400 and $500 million. How does that compare to some of the other big blockbuster franchises?
It's at the top of the heap. There's probably very few films that are going to cost more than that. If we ever do get another Avatar from James Cameron, I think you'll see that number higher than the Star Wars number.
Well, yeah, James needs to stay king of the world. Given all your caution, Ben, on Disney, does Disney need to use its cash flow for acquisitions or other investments rather than on share buybacks? I believe it's spent, what, $32 billion on stock buybacks since 2007.
Yeah, Disney has actually pared back their buyback activity lately, and compared to their peer group as a percent of market cap, they actually are buying back less stock than the other media companies. I think they've done a nice job balancing their capital allocation between dividends, which they raised recently quite a bit, buybacks and acquisitions. I think the tough challenge in the media business right now is what do you buy? There's clear headwinds to the television business, whether you look at ratings, cord cutting, And there's no easy solution to sort of buy your way out of that. So really owning powerful brands, powerful IP is key. Disney's already there. Kind of hard to find that out there in the market from an acquisition perspective.
Yeah, there just aren't that many Marvels or Lucasfilms around. I want to go back to ESPN and what you said about how that really is the bulk of Disney's business. You talk about modest subscriber erosion in your note and tough comps. So it sounds like a pretty mature business in need of a catalyst.
Yeah, ESPN obviously an incredible profit engine for Disney, an incredibly important network for distributors in the pay TV space. But not everybody watches sports. And as we think about the future of the pay TV bundle, we think we're going to see these skinnier bundles emerge, less networks being distributed, maybe more a la carte options for consumers. And I think you'll see pressure on subscribers. And for ESPN, all of their sports liabilities are fixed. So they owe the leagues money whether they have 100 million subscribers or 70. So as we watch this business evolve over time, that's going to be really important to track how the subscriber numbers in the bundle evolve against a fixed cost base.
All right. Thank you so much, Ben Swinburne. Really fascinating stuff. Ben Swinburne is with Morgan Stanley.